Welcome to the tax penalties panel. You all have the speaker biographies in your documentation, so I'm not going to expand on that. Maybe a small reminder of where everybody comes from. We have Jaco, who is a Dutch professor. João is a Portuguese tax specialist working for IBFD. Eric is a US attorney working for the taxpayer service in the taxpayer rights service in the IRS, and I'm Philippe, a French administrative judge. This leads me to a small language warning. We realized that during our discussions, Eric talked all the time about civil penalties, when many Europeans talked about administrative penalties. And so we realized we had a language problem, because in continental Europe, we tend to think there are criminal penalties inflicted by criminal courts, civil penalties inflicted by civil courts, and administrative penalties inflicted by administrations. It can be a tax administration or an environmental administration. Okay. So when a penalty is inflicted by an administration, in Europe we say administrative penalties. So when Eric says civil penalties, Europeans translate, please, administrative penalties. And when I say administrative penalties, Americans, please, translate civil penalties, okay? Okay. We are trying to answer a few questions during the course of this panel. The first question is, why tax penalties? Are they necessary? Are they efficient? Why? Why tax penalties? And Jaco is going to do that. The second question is, what kind of tax penalties, which means how can we set up a good penalty system if that can be found? And João is going to do that. And the third question is how to protect taxpayer rights in the area of penalties, which is a very sensitive area because, after all, penalties are not tax itself. It's not a contribution. It's a punishment. So there is a special issue about taxpayer rights in this respect, and this is going to be done by Eric. So please, Jaco.
Okay, thank you, Philippe. Thank you, Nina, for this opportunity to present. So I'm indeed going to talk about why tax penalties, and actually it's to enforce compliance. So that was it, I think. Okay, maybe a little bit more, but that's why I want to start with a little bit broader view on compliance, and I want to extend it a little bit to tailor-made supervision. So the effects of trust, audits, penalties, and support on compliance, and of course a focus a little bit more on penalties. So that is the idea. Before doing so, let me first make sure that we all have the same understanding of compliance and types of compliance. So in my view, compliance consists of the following: enforced compliance and the rest, which is voluntary. So we talk a lot about voluntary compliance. What is voluntary compliance? I think it's everything that is not driven by the threat of punishment. So I would define voluntary compliance as not driven by the threat of punishment. And that can be driven by economic motives, like it's good for my reputation, I will make bigger profits because it's good for standards or whatever, I can show off with it, all fine. It can also be because of values, right, that you think it's the right thing to do. So then we talk about moral emotions and things like that. So that are the types of compliance. And I want to discuss the role of penalties in relation with these two types of compliance. So this is more or less the agenda for the 45 minutes I have. Sorry, just waking you up. So, no, only 30 it was, right? So, no, penalties and compliance, the role of trust, and signaling support as a regulator. And I want to go through these three items based on 3 papers. I've never presented 3 papers in 20 minutes. I really have to go through the main results very quickly. I hope it is insightful in the discussion on the role of penalties. So first, penalties and compliance. Let me go back to the neoclassical economic theory. I'm a professor, by the way, so I need to go through these kind of issues. So a little bit of game theory, because of my mathematical background. This is basically the model that is used originally and then very shortly. What is the role of penalties? Well, we have two players. We have a taxpayer who needs to pay taxes or not. And we have a second player, which is a tax authority, and it can do an audit or not. And you can solve the game. What are the optimal strategies? Well, if you're caught, you have to pay a penalty if you didn't pay your taxes. And if you solve this game, the compliance rate here is something like 1 minus C over T plus Z, which is increasing in the penalty. So that is Nobel Prize winner, Becker, crime and punishment. We have to increase the penalties and compliance will increase, period. Not so. So then we would have had different observations. So two questions arise. The first is, we have this whole other block of compliance, the not enforced compliance, and this only talks about the enforced compliance. And what is the effect of penalties on not enforced compliance, on voluntary compliance? That is something to consider. And that becomes even more important given the tax compliance puzzle, as it is already called for decades. These equilibrium strategies that these neoclassical economic theories present deviate far from what we observe in reality. Right? In reality, we see people comply a lot, even if the audit rates and penalties are not high. And we cannot explain it based on these calculative motives. So we need more, and apparently there is a lot of not enforced compliance. And if you really want to talk about penalties, you should also consider the effect of penalties on this other block, the voluntary compliance. So that brings me to the first paper, which is joint work with Juan Mendoza. Everything is. He's a Colombian colleague, lives in Norway, works in Amsterdam, comes from Colombia. So we cover quite some countries, I hope. And with Erich Kirchler, who is over there, you saw him yesterday, about the backfiring effect of enforcement. And this paper focuses on auditing, but the logic also applies to deterrence in general. What is the effect of more deterrence? So I extend it a little bit to penalties. So this may be familiar to most of you, so I go through it a little bit fast. What is the effect of deterrence, theoretically, on voluntary compliance? Well, the first one, and that is negative, is distrust. If you say, if you do not comply, I will impose a strong or severe penalty, that signals that you distrust someone. So what happens is this signal of distrust increases the social and psychological distance between tax authorities and taxpayers. And that makes you enter a cops versus robbers setting, right? If you threaten with strong and severe penalties. So generally, how you're treated is how you respond. So taxpayers may reciprocate that behavior and enter the tax versus robbers. And if you threaten with penalties, then I'm only doing it because, well, you know, I don't want to pay the penalty. But if you're not watching, I'll do whatever I want. Right? So that is the behavior that this creates. A positive point from penalties on voluntary compliance is justice or fairness, the second one. It is good that if you are honest, that your neighbor who is dishonest gets a penalty, right? You shouldn't get away with everything. So there are positive things also. Limitedly, of course, because you don't want him to go bankrupt because of that. So that brings me to the third. It's not only fair, there are also unfairness things. And then generally what is talked about is procedural fairness or unfairness. How are you treated? Are you treated respectfully? And it's questionable if you have very severe penalties, whether that is that you feel treated respectfully. And if you don't feel treated respectfully, you might actually start behaving less compliant or less willing to comply. That's procedural unfairness. The last one, and that is the social norm. The social norm is, of course, it's good if you say we don't tolerate this behavior, so that is the small plus I put there. But also, if there is a lot of enforcement, people get the idea that evasion is pervasive. And they start thinking that actually everybody is doing that, so maybe that's the social norm. So it may actually, high penalties and high auditing may enhance tax evasion as a social norm, and people may start thinking that is the normal way to do, normal thing to do. So in conclusion, to some extent it is positive, but penalties may crowd out your intrinsic motivations to comply because you only do it to evade penalties. So these are the results of the study that we did, and you can, the table of countries, so you can see whether your country was in there. What we did was we looked at audit efforts in a country and related that to tax evasion in that country. And what we find is the following. First, increasing in auditing lowers evasion, but beyond a certain point, more auditing leads to more evasion. And I want to stress that this is previous auditing and subsequent evasion. It's not the other way around, then we do not find it. So the zero is because it is compared to the mean, so don't watch the numbers. So what we see is that after a certain level, auditing backfires. So increased auditing, less compliance. That is something that is a backfiring effect of enforcement. And that is something we should be aware of if you have high penalties. So in conclusion, we have this U-shaped association, which means that too much enforcement backfire and crowd out the intrinsic motivation. That was the first paper. The key question that we get now is, how can we safeguard this intrinsic motivation? Right? Well, if we look at the 4 things that we have discussed, like this may crowd out the intrinsic motivations. It was mainly distrust and procedural unfairness. Then what you want to do is the following. You want to signal trust. You want to signal procedural fairness, which is support and a cooperative attitude. So we see a lot of this going on, right? Enhanced relationships. They have increased popularity. I was planning not to say something about that, or not too much, but given I was just given an additional 5 minutes. So very shortly, they claim to be based on trust, these cooperative programs, but I think if you really go to the definition of trust, it is dubious whether it's actually trust. Because if you say, well, we are going to reduce the auditing efforts, but first you have to comply with this, you have to give us all the information, you have this tax control framework, where's the trust? Right? We just shift the control to the early stage. But trust would be, okay, we've seen you comply, we will visit you with less people next time. That's it. Right? That's trust. Trust is not convince us on forehand that we should do that. That is a side note. 2 studies I go through very quickly is trust for rational agents. It's again with Juan Mendoza. Only the carrot, not the stick, incorporating trust into the enforcement of regulation. Can we incorporate trust? And the other one is a recent field experiment that's about to be published. It's forthcoming in Journal of Accounting Research. And that's more behavioral. So the first is rational, calculative. The second one is behavioral. So what I did with Juan is incorporate trust into this neoclassical economic games, which is quite fun. So we actually think that we do incorporate trust and then solve the optimal solution. So we have this original non-differentiated audit rate, just the solution of the game. And then we say, okay, if we see that you comply, we lower your audit rate, lower your audit intensity. It's good for you because you have lower cost, and good for us as a tax authority because we have lower costs. And only if you are caught not complying, you go back to the original situation, no additional penalty, otherwise it would not be trust, by the way. It would not be trust if you say, okay, we lower your audit rate, but if you are caught, then you get an additionally severe penalty. Then it's not trust. It is, again, threaten to penalize. Is this possible? Is this possible? And it is received with a lot of skepticism because you lower the audit intensity. So what will they do? Of course they will not comply. Well, not so much. These are the results. If agents on average sufficiently value the future, this strategy that has always the same or less audit leads to higher compliance and reduces social costs. And this is for fully rational calculative agents. So it may actually work very well for firms if we think they are more rational than and less driven by moral emotions. Of course, there are people or firms that misuse trust that is granted to them. That will always happen. And that will be the ones that we find that have a short-term orientation. So if they do not value the long-term relationship with the regulator, then they misuse trust and go for the short-term gain of coming away with evasion. And the fun thing is, what do you do with those who are actually not audited? Well, we put them in a kind of waiting stage, like, let's see what we do with you before you're audited, right? We can trust you or not. And the optimal equilibrium strategy is to start off by trusting everybody, calculatively. Well, that's quite funny. Don't say it out loud to the auditors, but a very interesting insight with respect to penalties is that higher penalties make such a strategy less feasible. If you have higher penalties, it is harder to differentiate between the audit rates of those who you trust and those who are not yet or not trusted. So if you want to make this differentiated audit strategy, you cannot increase penalties too much. So indeed, enforcement and trust may not go hand in hand. So even for calculative agents, trust may be beneficial. Okay, so the third study that I wanted to show some quick results, I'm doing fine in time, I hope, is how do agents respond to a more supportive regulatory attitude. So we call for more horizontal approach. There is this call for more horizontal regulatory approaches, and on average we expect them all to be good, but some may exploit this. Well, we tried to find something in a field experiment that we did among financial intermediaries. Okay, it's not taxpayers, but you know, the idea is the same. What they have to do is send in a yearly self-assessment, and they get invitations to go there. So they get 3 letters to respond. Don't bother you with the details. 3 letters, introduction, username, and password letters. And we have consistently manipulated, and a group of 2,000 got a set of letters that showed high support. We are here to help you, and first names, not initial, so low level, you can easily approach us, things like that. And the other group of 2,000 randomly selected, same matched on size, etc. They got a more formal letter, more distant, and say, you are obliged to do this. So what happened? What we studied is what happened with reporting quality, which was how comprehensive do they report, how precise is the information, and how much voluntary questions do they answer. So that's behavior we consider. Well, here are the main findings. On average, it was not positive. High support did not lead to high reporting quality, which was, to some extent, a surprise. But it may be explained, and I think it's interesting, by the fact that many agents here in this setting, financial intermediaries, are quite skeptical about the role of the regulator and how good the regulations are. They think it's too extensive, so they already think that this setting is not so fair, which means that actually in such a setting they might not respond well to a supportive attitude. So a supportive, cooperative attitude may be good, but not if you have this cops versus robbers setting. You first need to change the culture before you can successfully implement a cooperative strategy. And that is further confirmed by two other findings. The first is generally these long-term oriented firms, we are really interested in that orientation, do you value the future? They respond with much higher quality. And this is, I think, the main interesting thing, this supportive attitude, support letters, lead to higher reporting quality for those firms that value the future more, that have a long-term orientation. However, the short-term oriented firms, they respond negatively to that. So they try to get away with the friendly tone, and they exploit the supportive attitude. And they report with a lower precision compared to if they would have given the low support, the more formal, distant letter, which I think is quite interesting. So if you really want to successfully implement these cooperative things, you need to tailor your supervision strategy. So what we advise is send different letters based on individual firm characteristics. Tailoring is the key forward. So a few implications, and then I will come to the final slide on how this relates to penalties. When using self-reporting, which is done a lot in tax, time horizon seems to be highly relevant. So what we need to get insight in is, do these firms or persons value the future? How much are they oriented towards the future? And in that way, we can target the regulatory strategy and tailor communication with these regulated agents. Realize that these supportive strategies are not without risks. There will always be firms or individuals who exploit it. But that doesn't mean that it's not good. It means that you have to be careful when and for whom to use what strategy. It could evoke a weaker sense of urgency and signal weak enforcement capacity. And these short-term oriented firms actually misuse this. So in general, tailoring is the way forward. And let me apply that to penalties. Penalties are part of the enforcement strategy. So let's try to use them as a tool, an instrument. And at least some penalties are good. For deterrent effect, those that are not intrinsically motivated, we need to threaten with penalties. But also to provide fairness to those who report honestly and see their peers not reporting honestly, right? They should be punished if they are caught. Proportional, but still, it is fair to do so. So some penalties are good. But we also saw that too much enforcement may backfire and crowd out intrinsic motivations. We have to be careful how to use penalties, and especially disproportional penalties. So, I already said the way forward was differentiate enforcement strategies, communication strategies, the whole package. Differentiate, do not generally implement these supportive programs, but tailor these based on individual data. And that comes back to another issue that was raised yesterday. We have so much more data. Use these data to find out about the motivations and the attitudes of those who are actually being supervised. Right? So we need to do something with those data and find out about the underlying motivations and attitudes, because that is actually driving the result, and that is what determines what penalties to impose. So I would make a case, preferably, to differentiate penalties. Differentiate penalties based on the underlying motivations and attitudes, to safeguard the intrinsic motivations and to punish undesirable behavior, so that trust and support, as far as you implement it, is not exploited. So this is the way to overcome these drawbacks and I think successfully implement these penalties. And that may require using discretion or adapting the law to differentiate penalties, and of course, good data analysis to really find out about motivation, attitudes, etc., because we can learn a lot from the data that are available. So I hope I'm not calling all kind of things like differentiation that you don't want, but we'll see about that, right? Okay.
Thank you very much, Jaco. Tax penalties are a very political issue. So it's interesting to know that there is research on the actual efficiency of the application of tax penalties. Before Juan starts, maybe I would like to ask two questions regarding the reason for tax penalties. The first question would be, what are the goals behind tax penalties? Is it for punishment and fairness? Meaning that, well, we punish because it's necessary to punish, because there is the misbehavior by taxpayers, and plus it's fair for compliant taxpayers to know that non-compliant taxpayers are going to be punished. So it's punishment in a way for the sake of punishment and fairness. Another reason could be deterrence. Penalties could be used to deter taxpayers from misbehaving. So that would be another goal, very practical in a way. This is, I think, where Jaco more or less is leading to. And a third goal could be, well, public revenue and compensation. In law, many people have argued a long time ago that penalties were about compensation. For instance, time limits. You have a tax audit on a really non-compliant, devious taxpayer, but the time limit is 4 years for adjustments. And you realize this guy has been misbehaving for about 20 years and making lots of money by misbehaving. So you say, well, at least the Treasury is going to collect more money back by applying heavy penalties on top of the tax. Just 4 years of tax back, but plus penalties, at least the Treasury gets more money back. So that's the compensation side of it. So in real life, what do you think the goals are or should be?
Yes, thank you, Philippe. Yeah, I would definitely go for the first two, right? Fairness to those who are actually honest and the deterrent effect. I would be a little bit critical about the compensation. I know it's argued, but there is a high risk because it's based on assumptions that someone has behaved in a certain way. I would say you should control and check whether he actually did before imposing, because if you increase penalties because you assume that those who actually misbehaved did so for a long time, well, then you are really going to unfair treatment. And this is, I think, the risky part for those who are complying, because this increases fear, and fear is a negative emotion for compliance, and that is basically what I'm afraid of. So you will impose fear instead of pride or some more positive emotions for people to comply, or honesty. And if you are feeding fear, then people become not people who want to comply, they become people who want to evade but don't do so because they are afraid.
I agree with Jaco. It seems like procedural fairness is, it's not just voluntary compliance. Jaco's study seems to suggest that proportionate penalties promote voluntary compliance, and there's other studies that show that as well. There's another reason, though, for proportionate penalties, and that is for fairness, and because that's just kind of the norm that we have that are embedded in our Constitution and Universal Declaration of Human Rights and taxpayer rights in general.
Well, frankly, I had a second question. We may not have much time to discuss it. Just mentioning to allow everybody to think about it. In recent years, we had two developments. One development is the fine-tuning of tax penalties, especially in the BEPS era. Penalties are being fine-tuned in several countries, especially when non-cooperative jurisdictions are involved. But at the same time, many countries are developing trust-building policies. And right now, in French Parliament, you have two bills being discussed. One bill on creating a society based on trust. Very fine words. And another bill in Parliament at the same time about fighting fraud. And so in both bills, you have tax provisions. Tax provisions about building trust, and tax provisions about fighting fraud and increasing penalties. Especially naming and shaming is being introduced in the fraud bill. So sometimes you have to reconcile the two and think about, well, do I have to tailor my tax penalty system in order to be compatible with my great trust-building policies? So maybe we don't have time to answer that, but I'm afraid the two things may just move forward separately in a parallel fashion. So maybe sometime we may have to think about to reconcile the two approaches, each approach having its reasons, of course. But I'm afraid that people who create the norms may not think every day about the real connection between the two. Okay, I'm afraid we may have the time to, because it's a huge topic. So please, Joel.
Many thanks, and many thanks for the organization for this invitation to present the results of my research. Before all, I would like to invite you to join me on this journey 35 years ago. 35 years ago, I was a kid, and I often visited my father at the office of the tax authorities. And this picture was not taken by me, but it could be taken. There were huge piles of paper where all the information was gathered. And the biggest of all was the one of penalties. And I remember still the staff member in charge of penalties. And I think he gave me one of the best advices to ensure compliance and to avoid penalties. And his advice, and you have to picture a person in an office without windows, without air conditioning in the 80s or 90s. His advice was, if I was government and to ensure compliance, I would ask every tax evader to do this procedure instead of me. And I guarantee to you, if they are here in August without air conditioning, filling out all these papers, they would not do this. Of course, I'm not going to speak more about this because this is not taxpayers' right, but the topic that we are not covering, which is tax authorities' rights, and eventually the right to an office with windows, with air conditioning, etc. On the menu for today, I'm going to discuss some of the types of tax penalties that we have. And I'm starting, I know it's surprising, by death penalty and torture, moving to imprisonment, monetary penalties, accessory or ancillary penalties, out of the Catholic penalties, and then selective topics. How did I decide to do, or what is my research about? I first thought that we are doing research on penalties isolated, in silos. We don't speak to each other. We speak a lot within our countries, but we don't dialogue. So my goal was to make a breakthrough and to get results and move research on tax penalties to a next level, to the comparative level. So I wanted to see how penalties are applied throughout the globe. And for that, I selected and I used the data that we have already at IBFT, which is a survey of 69 jurisdictions that were displayed on the previous slide and that are currently displayed on the slides that they can also download from the website. And regarding each one of these jurisdictions, data was aggregated in 8 criteria. 8 types of tax infringements: failure to register, omission or late payment of taxes, omission or late filling of returns, inaccurate or frivolous filling of returns, refusal to provide information and similar obstructionist behavior, tax fraud and evasion, failure to keep records, and erroneous refund or credit claims. Of course, this doesn't match with any jurisdiction, but this is the criteria that we have at IBFT Tax Research Platform and that we analyze the world with it. So, this being said, I will start with one type of penalty that is very hard to grant taxpayers' right when it is executed, which is death penalty. And I'm happy to report that currently death penalty doesn't exist. But it was not the case a couple of years ago. And this is a major leap in terms of taxpayers' protection, because a couple of years ago, there was a major country that still executed people for failure to infringe taxes. And you may think, okay, it was a country, I didn't contribute for that, my hands are clean. But in fact, I started to analyze instruments for mutual cooperation and mutual assistance. And I reached the following conclusion. If you go through all treaties and through all mutual assistance instruments, you check that there is no single treaty in force that actually says or spells out that you cannot have mutual assistance, that you cannot exchange information, if that will conduct directly or indirectly to death penalty. It currently doesn't exist in the world for tax infringements, but there are connected infringements for those that death penalty exists. So we have ordre public, but we don't spell out. There is only one treaty, the Germany-Tunisia Treaty, that is not yet in force. It was signed a couple of months ago that says that the Republic of Germany considers that information exchange cannot be used for death penalty and thus creates this protection. Let's think on models. And there is one model, the CRS model, that says in section 5.2 the following. Certain jurisdictions may, and watch for the devil is always in the details, may require their competent authorities to specify that the information cannot be used for the imposition or execution of death penalty or torture. And then there is the highlight of this sentence, and I'm not sure if this was on purpose, cannot also be used for severe violations of human rights. And I stress severe. If I say severe, does it mean that mild violations of taxpayers' rights are possible? Can we use these for mild violations? And for me, the words severe and mild come also with food, with spiciness. I often ask, is this spicy? No, it's mild. And at the end, I get my mouth gets burned. There is only one treaty, actually, that incorporates this protection that is suggested in the CRS. And this treaty is the Italy-Panama Competent Authority Agreement. That also says information exchange may not be used or disclosed in proceedings that could result in the imposition or execution of death penalty or torture or other severe violations of human rights. So far, if you think that your country does only mild violations of taxpayers' rights, you are still fine, and you can request mutual information, which leads to my first remarks on this section. There is a consensual rejection of death penalty currently. That doesn't mean that in the future, a country doesn't decide to introduce that back again. And our instruments of public law should be prepared to prevent this. Not only death penalty, torture, or any kind of infringements of fundamental rights. So we need to incorporate this protection in our tax treaties. How? Changing tax treaties and spelling it out. These cannot be used for these purposes. This is not a matter of interpretation of the ordre public clause. We need to spell it out. And I think also, I suggest that we should revise our commentaries spelling it out that this type of the information cannot be used for this, and this note is a mere clarifying note. So ambulatory approach. Let's go for imprisonment. And in this graphic that you can also download, you can see countries that apply prison sentences for tax infringements. There are some in light green or darker green that only apply very lightly, less than 1 year. Then others in yellow up to 5 years, from 6 to 10 years, and from 11 years to 20 years. And yes, there are still countries that apply 20-year jail sentences for tax infringements. In what concerns imprisonment, jail sentences, I think there is a consensus around the world that these should be seen as a last ratio or ultima ratio of the system, that we should only use these when it's no longer possible to use other possibilities of sanctioning. There is a wide diversity on design, several different characteristics. And one thing that I also noticed is that there is a strong judiciary restraint in the application of jail sentences. Although it's allowed in the law and sometimes for very long terms, from a judicial perspective, they are very restrained in applying it. Monetary penalties. All jurisdictions analyzed apply monetary penalties. So this is all jurisdictions that I analyzed. And there are mainly two ways of setting these penalties. The first way is by reference to a percentage of the unpaid tax. And the second way is by referring the penalty to an absolute limit that is fixed in the currency of the country. For the purposes of allowing this analysis, I converted everything into euros because we are in Amsterdam right now. So if you assess penalties by reference of a percentage of the unpaid tax, you can get maximum penalties that can go from very 20%, 25% in some cases, up to 1,000%. Just to clarify, 1,000% is that you have to pay as a penalty, besides repaying the tax, 10 times the amount that you have not paid. And also, if it allows a little bit, if it allows a better assessment of the status of what's going on in the world, you can see also in this map with also colors from 0 to 100%, 100 to 300, 300, 500, and in red, more than 500%. Then there are countries that set their, or alternatively set their penalties by reference to a maximum amount in the local currency. And I'm here only concerned with the maximum amount, and even if it's only for severe cases. And you may tell me, this graphic is unreadable. And I agree with you, but I still brought it for your consideration. If you take in consideration all the countries assessed, you see that there's a high disproportion between the maximum penalties in jurisdictions like Vietnam, Uruguay, and Pakistan, and in other jurisdictions where the maximum penalty, and in this case I triple-checked with people from this jurisdiction, exceed the 4.5 million euros. So we go in terms of maximum penalty from the 200 euros to 4.5 million euros. And this is also, and you can check later, how it looks like in terms of Mappa Mundi. So jurisdictions that apply up to 10,000 euros, from in green, 10,000 euros to 100,000 euros in yellow, then up to 500,000 euros in orange, and more than that in red. And there are some systems that are worth mentioning, and I just picked two cases. In one of the cases, I noticed that you can apply, besides these penalties, also confiscation of up to half of your property, or even 20% of the non-reported assets. And there are funny examples that I found also, that you can set like a 1,000% penalty, but then it is capped to 2,500 euros. Not for all cases, but it looks like a very strong penalty, but then at the end, the maximum you pay is 2,500 euros. So there is a lot of diversity. And this diversity occurs among countries and even within the same country. There's a lack of continuous between administrative and criminal penalties. There is not even a consensus of the most serious breach. Sometimes the most serious breach in administrative terms doesn't match with the most serious breach in criminal terms. One thing that I would like to stress is there are still cases in the world where there is imprisonment-only penalties. And I wonder, is this justified? Is this proportionate? Question mark. I don't think so. There are also third type, ancillary penalties. And there are also penalties that go beyond the prison and monetary penalties, as the interdiction to exercise certain activities or professions, bans from the right to contract with public entities, to access to fairs, auctions, etc., or non-eligibility, for instance, for subsidies or for contracts. These are the temporary measures. But there are also definitive ancillary measures that are normally applied in connection with a monetary or a jail sentence. For instance, winding up of the company, the famous naming and shaming that appears with a lot of differences across the world, loss of property, confiscation, I gave you already an example, and the loss of property of the instruments used for the crime, and a trend recently that I noticed recently, extension of the statute of limitation. This is something in the last 5 years that you see across the globe. Finally, and this is the last type of penalties, and actually it's not really a penalty, I called it out-of-catalog penalties. There are non-written charges that at the end have the same burden as a penalty. And these arise in areas where the tax authorities have a wide or some margin of discretion. For instance, inspections, precautionary measures, reimbursements of VAT, etc. And they are not considered penalties by the doctrine in most of the countries. But the effect of this exercise or heel exercise of discretion is that the taxpayer is faced with a burden that may be as harsh as an on-catalog penalty. And there are some methodological issues connected with these penalties. The burden may correspond or even be higher than that one of the in-catalog penalties. It's difficult to collect evidences. If my VAT credit is delayed, how can I show that there is a practice, that there is a normal pace of reimbursement? There's also difficulties to use the legal remedies that we currently have. We can react to a penalty, but how can we react to a non-retail penalty or out-of-catalog penalty? How can we do that? I honestly tried to see, and at least in most of the systems that I know, this is not possible at all. So my conclusion is that we need to lead them back to the legal framework of penalties, and if there is a burden that is imposed by a tax authority, and this burden has the same effect or higher than a penalty, then it needs to be called as it is. Focus on the effect and not on the nomen juris. Some topics that should be further scrutinized. Automatic versus discretionary penalties. Some systems have a clear preference for automatic penalties. So you forget to deliver a tax return, immediately you pay 50 euros, 100 euros. Whereas in other systems, you always ascertain the situation of the taxpayer. And you see, okay, he was in the hospital, or he was submitted to surgery, or someone on his family died and he couldn't do that. There are also advantages and disadvantages of both systems, but I think we should look at it and compare experiences to reach the best solution. And the best solution should be eventually a mix of automatic with the possibility of appeal within tax authorities. Then the ongoing discussion between civil administrative penalties and criminal penalties on the other side. There is a huge difference between systems. We don't even agree in calling civil or administrative penalties on one side and criminal on the other. And in many systems, they just label it as administrative penalties, and then the effects and nature is the same as a criminal penalty. And thus, we need to really focus not really, again, on the nomen juris, on the classification that we put on the penalties, but on the effects and on the nature of what is being criminalized or what is being penalized. Then the topic of tax avoidance. Can we apply penalties for tax avoidance when the taxpayer relies in the letter of the law but goes beyond the spirit, praeter legem? Can we apply penalties? And even within the jurisdictions represented on this panel, we have very different responses to this. And some clearly reject penalties for tax avoidance, for taxpayers that relied on the letter of law, aggressive tax planning, which the OECD considers legal, but didn't comply with the spirit of the law. Room for discretion in penalties, graduation, negotiation of penalties, and also, lastly, precautionary measures. We often don't put it in the framework of tax penalties, but some precautionary measures have the same effect, the same burden of penalties. And we need also to rescue them to the framework of penalties. This leads me to my last slide. At the end, penalties, and most of the countries' penalties penalties are understood as an expression of the jus puniendi of the state. So an expression of this right of sovereignty. And tax penalties are usually linked with other penalties, with criminal penalties, with administrative penalties, and that creates a major disruption in what happens in the world. Because it's connected with other penalties, there is no correspondence between tax penalties across the globe. And there are fundamental discrepancies in the codification, in the design, in the application, and also in the contrast between design and application. But I believe, and I believe this group, this conference should eventually reach a consensus on this. There are idiosyncrasies in tax matters that require us to do more. First, mutual assistance should not be available when the consequence is death penalty. And yes, it can return in the future. Mutual assistance cannot be available when the consequence is torture. And mutual assistance, I would dare to say, should not be available for mild or soft infringements of taxpayers' rights. Even if I use a goose feather to put in the foot of the taxpayer, that's still an infringement of his rights, and we shouldn't use the information for that. Second, for tax purpose, there is a hierarchy of values. And we share much more than we disagree in terms of these values. So we could reach global consensus about the hierarchy of values, the hierarchy of infringements, and the hierarchy of sanctions. And I hope that this presentation opens research on this area. Third, we need supranational criteria to examine and to distinguish criminal infringements and criminal sanctions from administrative or civil sanctions. I think it's no longer the time that we have in Europe the Engel criteria and we somehow have the problem solved, because if an administrative sanction has the nature of a criminal sanction, the European Court of Human Rights asks for the criminal guarantees to be used, but that is not shared all across the world. And finally, because you think that this would be a global trend and this would be a global protection, judiciary review. we need to ensure that every single penalty allows for an independent discussion at the judicial level. Thank you so much for your attention.
Thank you very much, João. It was a huge field to cover in 20 minutes. I may have one short comment on the small area of discussion with João. The comment is that in some countries, there might be a problem with the nebis in idem principle. Countries where treaties are superior to domestic legislation, and therefore in human rights treaties, you have the nebis in idem rule. And so you may have case law problem, especially in the European situation. We have case law from the European Court of Human Rights and from the European Court of Justice. There is a recent Luca Menci case from March 2018. And the outcome seems to be that you can have both criminal penalties and administrative penalties, but you have to have a public interest reason, and you have to coordinate the two systems. So there are different ways of coordinating the two systems. The French way is very simple. The Constitutional Court has decided that the way to do it is to put a ceiling, which means that you can combine the two, but only to the limit of the highest penalty range. So that's very, very simple. One small, perhaps, disagreement with Jean on the issues of ancillary and strange penalties. On ancillary penalties, I think there are two cases. One case in which the ancillary penalty has no reason other than punishment for tax reasons. It's like revoking a driver's license or a passport. You don't see any reason to do that except that punishing somebody for tax misbehavior. There are other cases in which there might be non-tax reasons. For instance, in certain professions, you may have morality requirements. So if somebody misbehaves in the tax field, you may have a feeling that maybe this person is not fit to exercise this profession, which requires a moral rectitude. And so you may have a ban for a number of years for exercising the profession. You also have the issue of public procurement, because you may argue that a company that cheats on taxes has an unfair advantage versus companies that are compliant. And therefore, it may be a fair competition issue to bar companies that gain money by cheating on taxes versus companies, to avoid disadvantaging companies that are compliant tax-wise. So that would be a non-tax reason to do something. So I would draw a line between ancillary penalties that have no reason other than tax punishment, and other ancillary penalties that may have a reason beyond just tax punishment. And the second comment would be on your strange out-of-the-catalog penalties. Some are plainly illegal, in my view. I take the example of unjustified delays in reimbursements. Yeah. I mean, either you have a statute saying, well, there is a time limit for reimbursement, and even if you don't have a statutory limit, there is case law about reasonable time. And so if the reimbursement doesn't come in reasonable time, it's illegal, and the government is liable to compensation. Other cases are just targeting or tailoring. I mean, you have seen a non-compliant taxpayer. Why you just target him for the next audit round? Is there something illegal about that? Just targeting and tailoring. It's administrative procedures. You have audit programs, and the guy who misbehaves ends up on the top of the audit program for next year. So what's wrong about that? Do you have a...
Oh, yes. As I mentioned yesterday, I think that a sanction, and sorry for Eric, a sanction, when you have an infringement, you are given a sanction. And that's it. You expiate all your, everything that you have done in the future, everything that you have done with that sanction. And I believe that that error that you made in the past shouldn't follow you through all your life. And about profiling, I told you yesterday that many countries discuss whether you can profile taxpayers based on what that sociological group does normally, if they are Hispanics or whatever. And I think that profiling is very, profiling attached to being, have been in the past subject to a penalty, I think it's very difficult, and it leads to situations as we see now that some person, just because did an infringement in the past when it was young, served 5 years in jail and cannot find a job anymore, and I'm strongly against that.
Okay, time for Eric. Sorry about that.
Thank you. I'm Eric Lopresti. I'm a senior attorney advisor with the Taxpayer Advocate Service at the IRS. I just have to provide a disclaimer that nothing I say today, it should be attributed to the Taxpayer Advocate Service, the U.S. government, or the Treasury Department, or NINA. So I'm working on a paper about the structure of penalties. And for today's talk, I've been asked to talk about a subsection of that, which is how to protect taxpayer rights. And this is kind of a work in progress, and it's a very normative analysis based on what I've observed about taxpayer rights so far. So first, why taxpayer rights? Well, as we've discussed before in a few of the other talks, taxpayer rights are a human right, and they're embedded, human rights are embedded in our Universal Declaration of Human Rights as well as the U.S. Constitution. They're just part of who we are. And so there's a reason aside from voluntary compliance to observe taxpayer rights. Also, legitimate governments avoid arbitrary attacks on a person's reputation or taking their property without due process. And a penalty essentially accuses somebody of doing something wrong. So that's an attack on their reputation. In the criminal context, we require the government to prove crimes beyond a reasonable doubt because we want to preserve the moral force of the law. The other reason, as Jaco's talk highlighted, was that trust promotes voluntary compliance, and taxpayer rights, observing taxpayer rights promotes trust. NINA did a study in 2012 where we looked at Schedule C taxpayers who were self-employed in cash businesses. We surveyed them, and we surveyed them on a wide range of factors, including their trust for the government, their trust for the IRS, and their trust for the tax system. And then we looked at the IRS's measures, their best guess about their compliance levels. And in fact, we did find a strong correlation between trust for the government, trust for the IRS, and estimated compliance. So what taxpayer rights are most relevant to the discussion of penalties? I was looking at the right to challenge the IRS's position and be heard, the right to appeal in an independent forum, the right to expect that enforcement is no more intrusive than necessary, and especially the right to a fair and just tax system. Now, the right to a fair and just tax system includes the right to expect that the tax system will consider people's facts and circumstances. And I think that's one of the key points of tension when we're talking about penalties. So it's hard to define disproportionality, but by definition, disproportionate penalties are unfair and violate the taxpayer's right to a fair and just tax system. They're even more unfair when you don't consider the taxpayer's facts and circumstances and you apply these penalties to compliant taxpayers. As I said, it's difficult to determine what's a disproportionate penalty, but here's an example of what I thought was disproportionate. In order to settle threats of even harsher penalties, in 2009, the IRS came out with an offshore voluntary disclosure program where people would agree to a penalty so that they would avoid even harsher penalties. And in this program, people failed to file a form reporting their foreign accounts. And they also may have failed to report some amount of tax attributable to those accounts. And this was back before the streamlined programs and other programs that gave them other avenues to settle these things. And we looked at the taxpayers that participated, And unrepresented taxpayers in the bottom 10% with foreign accounts, median foreign accounts amounts of below 45,000, who were unrepresented, ended up paying over 700% of their understatement in order to settle these penalties. Whereas the top 10% with median offshore accounts of more than 7 million paid about 300%. While still very high, this seemed disproportionate and not tailored to the facts and circumstances of those taxpayers. So the IRS could avoid some disproportionality by using its discretion, and it has a lot of discretion. It has the discretion to allocate its resources to avoid developing penalties. It can settle penalties based on hazards of litigation, that is based on what courts might hold. It can compromise based on effective tax administration, which includes considerations of equity and public policy. It can abate excessive assessments under 6404, and it can assert less than the maximum penalties provided by law. In the Taxpayer Advocate Service, we've observed that they place guardrails around the use of these authorities that makes them very, very narrow. As an example, the maximum civil penalty for the failure to file an FBAR is the greater of $100,000, or 50% of the maximum balance in the account for willful violations, or $10,000 for non-willful violations. Back in 2009, when this program came out, the only discretion that the IRS had to impose a lower penalty was mitigation guidelines provided in its IRM that applied to lower income taxpayers who cooperated. It was very limited provision. After there was some word in the press that some of these penalties were so severe that people might raise valid constitutional challenges to them, the IRS more recently came out with some statements that it would only impose one penalty per year, not per account, and it would generally limit willful penalties to 50% of the account balance. So why does the IRS feel so constrained about using its authority? I personally think it's concerns about deterrence. As Jaco mentioned, if you have a 1% audit rate, you might need a penalty of 900% in order to deter taxpayers, and that's just too high. But the IRS is still concerned about keeping some level of deterrence. It's also concerned about processing efficiencies. It takes a lot of resources to consider a person's facts and circumstances, and the IRS just does not have a lot, and so that's another concern it has. And finally, it's also concerned about claims of special treatment for certain taxpayers and consistency. The tax court took the position that the IRS's authority to abate excessive assessments was fair under the facts and circumstances. And Judge Posner reversed that one of those decisions, and his comment in that case, I think, is illustrative of the IRS's view of using its discretion. And Judge Posner said, discretion without standards is a monkey wrench tossed into the machinery of tax collection. So I think the IRS agrees with that. This slide just highlights another study that we did of Schedule C taxpayers. Those are small businesses that were subjected to a penalty. And we looked at a wide range of penalties, and those that were defaulted, abated, or appealed, we thought those were the most likely to be viewed by the taxpayers unfair. And when we looked at the taxpayers' subsequent compliance, those taxpayers were less compliant in subsequent years. And so that kind of supports what Jaco was saying, that when taxpayers view their penalties as unfair, it's not promoting voluntary compliance. Disproportionate penalties can also increase the incentive for disputes, discourage agencies and courts from applying the penalties, and over-deter or blunt tax incentives that Congress wants people to take advantage of. So another category of penalties that we may want to avoid if we're concerned about disproportionality and fairness is strict liability penalties. Strict liability penalties are disproportionate when you apply them to people who acted reasonably and trying to comply in good faith. Now, I'm not saying there's not good rationales for strict liability penalties in certain circumstances, but this is certainly a concern when we're talking about how to promote taxpayer rights. As an example, in 2004, Congress got fed up with tax shelters, and it enacted 6707A, which allowed the IRS to list certain transactions. And if you didn't report these transactions both on your tax return and to the IRS's Office of Tax Shelter Analysis in a timely fashion, you could be subject to extremely high penalties, even if the transaction was actually not determined to be wrong. I mean, the reporting was not determined to be wrong. And we had those cases in our office. And it could even apply if you didn't report your transaction retroactively, if the IRS listed it later, and you didn't send them a form long after you filed your return. We proposed some legislative changes that would address this disproportionality, and Congress agreed. It now limits this penalty to 75% of the understatement resulting from the transaction. Another form of strict liability penalties is what I'm calling de facto strict liability penalties. They're not strict liability penalties, but they become de facto strict liability penalties based on the way the IRS administers them. As an example, the IRS has an automated matching program where it looks at third-party information reporting and compares that to what you reported on your return. And if there's a mismatch in more than 1 year, the computer will automatically propose a negligence penalty without ever determining if your conduct was negligent. So that might be the correct answer for the majority of cases. But if you're a low-income taxpayer who can't respond to the IRS letter or can't understand the letter, then you're basically subject to a strict liability penalty for failure to answer the IRS's letter. Non-monetary penalties are another trend. California recently enacted some legislation that publishes the names and addresses of taxpayers with the highest tax delinquencies on their website. It also denies them licenses, driver's licenses, and professional licenses, things like that. These types of non-monetary penalties are becoming more and more common. Congress recently enacted legislation that allows the IRS to work with the State Department to deny passports or revoke passports of seriously delinquent taxpayers. So these type of penalties can be unfair because not everybody uses these government benefits, so it's applying a different penalty to different people. So for example, if one business depends on their reputation and the other one might get more clients if they're on a list of tax delinquents, it's a penalty for one and not a penalty for another. So there's some horizontal equity issues there. Some professionals depend on licenses and some don't. Notwithstanding Philippe's comment about some professional organizations do have reasons to only want people who live up to certain ethical standards. That's kind of a non-penalty issue in my way of thinking. So the fact that a lot of these new non-monetary penalties are new means that they're not the norm yet, at least not in the federal level in the U.S. Why is norms important? Well, the Supreme Court has used a norms analysis to determine if criminal penalties are cruel and unusual punishment. It looks at what do other jurisdictions, what penalties for similar conduct do other jurisdictions have, and whether crimes that are more severe or less severe, the penalties for those crimes are kind of in line with the penalty you're looking at. And so norms is important there. Also, it seems that non-monetary penalties can infringe basic liberties, such as the right to travel, as I already mentioned. And so those are more likely to be seen as unfair. So one way that non-monetary penalties could be turned around and not be so surprising to taxpayers was proposed by the National Taxpayer Advocate in 2007. She proposed that before getting a license to enter into certain cash businesses, the business would first get a tax certificate from the IRS to show that they were compliant. If you have to go and get a tax certificate before you can become a construction contractor, it's not a surprise later on if your construction contract license is pulled for tax compliance. That makes first of all, it prevents non-compliance. It may also change the norms in the industry so that you don't have to be non-compliant to survive economically. And it also makes it so that it's not a surprise. Next, I was asked to talk about procedural protections that could improve penalty administration. So before imposing non-monetary penalties, a lot of governments only, they recognize that these should be as kind of as a last resort. And so they only apply them to the most egregious cases. Remember, I said it was only the top 500 delinquencies that California published. Also, the taxpayer usually is not appealing, has been notified that the penalty will apply, and yet has declined to pay or establish that he or she cannot pay or enter into a reasonable payment plan or offer in compromise. Another procedural protection is that the agency can be given the authority to abate and settle. As I said before, the IRS is somewhat hesitant to use these discretions, but their availability does help to reduce the unfairness of penalties to taxpayers who cannot pay or who have other reasons for not complying, such as reasonable cause. The IRS has a program called the First Time Abatement Program that allows it to waive penalties the first time somebody slips up, and that seems to make a lot of sense. Another taxpayer right is to ensure that the agency can reconsider its audits, that people can appeal the examination function's determinations to an independent function, and that the judiciary can review these determinations before the penalties are paid. If you don't have a prepayment forum to go to court, to get a court to review these penalties, then if you don't have the money to pay them, you don't have the right to judicial review. And examples are a little bit uneven in the U.S. about whether we have these protections. The tax court provides a prepayment form for most tax deficiencies, actually for all tax deficiencies, but not all penalties. For example, 6707A cannot be reviewed by a court. Those penalties can't be reviewed by a court before they are paid. Also, certain preparer penalties, Congress has kind of split the baby and requires the preparer to pay 15% of the penalty before they can get into court. The last panel discussed burden of proof and production. I'll only say that 7491C does shift the burden of production to the IRS with respect to penalties, but the taxpayer must still establish defenses such as reasonable cause. And actually, that probably makes sense because otherwise the audits would be much more intrusive. If the government had to prove a lack of reasonable cause, imagine all the fact-finding it would have to do before it could propose a penalty. And the ABA, I think, also opposed putting that burden on the IRS as well for the same reasons. Also, the burden is a little bit uneven on certain penalties. As the last panel mentioned, the government has the burden to prove by clear and convincing evidence that a taxpayer engaged in tax fraud before imposing fraud penalties, but it only has a burden to prove by a preponderance of the evidence before it can impose a willful penalty for failure to file an FBAR. So that burden of proof is a little bit uneven. So I'll just sum up by saying that penalties should be coupled with procedural safeguards, but in practice, the safeguards aren't always effective. Overly severe, strict liability, and non-monetary penalties are not good options. A better approach is to make compliance easier, reduce the opportunities for non-compliance so that it becomes the norm, and make it so that penalties rarely apply and only behavior that's outside the norm is penalized. If the government only penalizes, uses penalties rarely because most taxpayers are complying, then when it does act, its actions are viewed as trustworthy and its penalties legitimate. As discussed, this should move us up the compliance curve, as Jaco noted before on the other slides. Thank you very much.